Awesome. Well, guys, thank you so much for joining me today. I'm Whitney. I'm the Director of Investor Education here at PassiveInvesting.com, and I'm joined here with Scott Maurer of Advanta IRA. Scott is an amazing wealth of knowledge in not only helping people repurpose their monies, move their monies out of Wall Street, but into a self-directed environment. But I had the pleasure of doing a live webinar with Scott last night, and he can just take this complex topic and really distill it down for you guys into simple terms, actionable steps. So I'm super excited to have him on today. Guys, before we get started, just wanted to let you know that if you have not already joined the PassiveInvesting.com Investor Club, make sure to do that right now. Go over to PassiveInvestingWithWhitney.com. You can fill out a quick little application there. I have some free goodies for you. But more importantly, you get some additional tools and education to help you along your path of passive investing. As well, you can hop on the phone with me and get connected to our active deal flow. But right now, Scott, I'm going to turn it over to you. And like I said, I'm so excited from this, especially after our presentation that we did last night. I know everybody's going to get immense value out of this. But let's go ahead and kick it off. Like, how did you get started and connected into, not only working with IRA monies, but, just the self-directed environment in general?
Sure. So like some of the people on the call, I knew very little, if not almost nothing, about self-directed IRAs. Actually, when I started with Advanta, I had just graduated law school. So I'm an attorney by degree, although I don't do any legal work for our Advanta clients. And the owner of Advanta is also an attorney. So that's how I got connected to our owner, Jack Callahan. And needed help getting the business was only, I think Advanta was in its second or third year and still trying to kind of in its infancy. So I was brought in to really just help with help clients, basically be a client service manager in a sense for a while in helping people through the deal flow, but also then later transitioning more into growing the business. And in growing the business, we do that by simply spreading the word really to what a self-directed IRA is. The ability to use your IRA account to invest in all things real estate and beyond. So kind of that's really how I got introduced to the self-directed IRA world. But I started really knowing very little. I knew very little about IRAs. I mean, I knew what they were. I knew they were a retirement account. I'd had a small IRA or it was actually an old 457 plan when I worked for a city here in Florida. Is how I got started with my retirement account. Knew very little, but have learned, spent a lot of time those first few months just soaking it all in and really just trying to get as much information as I could. And certainly over the years now, have seen a lot of people do different things. People ask a lot of different questions, which has helped me grow as well from an education perspective. So that's really how I got started. Just kind of brand new, green, learned the business over the years and just have continued growing and continued educating. And I really enjoy teaching, so I really appreciate you having me on today.
Absolutely. Again, so excited to have you here. So, let's just start off like at the very beginning. Like, can you just, give everybody here just a little snippet of what a self-directed IRA actually means and how that differs from what they have perhaps with their employer?
Really? So yeah, the accounts people have with your employer, or maybe if you've had an employer's plan and you rolled it to an IRA with a brokerage firm, those accounts primarily are limited. If you're looking for what investment options you have, you're limited to investing in mutual funds, stocks, bonds, and really what that particular custodian will allow you to invest in on their platform. So it's a custodian is making a determination of what they're willing to hold. With a self-directed IRA, and an Advanta IRA is a custodian for self-directed IRAs, we don't sell any investments at all. So what we provide is a mechanism for you to keep the money inside of your IRA. So you have an IRA at a brokerage firm, it's tax protected. You can keep that money tax protected with a self-directed IRA, but instead invest in a variety of different assets. So instead of investing in mutual funds or stocks to grow your portfolio, you can invest in any type of real estate. You can invest in private loans. You can invest in startup companies, precious metals. The list really goes on. And we facilitate that because the brokerage firms have chosen that they don't want to hold these types of assets on their platform. It's not that it's against the rules or the IRS prohibits these investments. It's that the IRA custodians, those brokerage firms, simply don't want to hold it. So when it comes to, say, a real estate syndication, That's just something you can't do through a Fidelity or through a Schwab or someone like that. And that's why you need a custodian like Advanta, who is not limited to the different types of investments that we can hold in the accounts that we administer.
I think that's so important. I remember when I was still working in the community pharmacy environment and started reading about just not even about self-directed accounts, but just, I think it was Tony Robbins that put out Money Master the Game. And, he was talking about how Ray Dalio had broken down his portfolio. And I'm like, okay, like I was good friends with the benefits manager, and I knew she was one of the fiduciaries of the company's plan. I'm like, okay, we got to get commodities in, we got to get like some real estate exposure and all that. And she was like, oh no, honey, that decision's been made. And I was so distraught. I'm like, so I had a choice of, I think, 3 different ETFs or mutual funds that I could go into, or like maybe 2 or 3 other like life funds. And that was it out of everything. And I was just like, I was so disenchanted. And I was like, how is this benefiting me? And so when I started learning about the self-directed environment, then I was like, how can I get a hold of my funds? Like, how can I move this into a self-directed environment? And let's talk about that, because I know there's some people here that are like working full time and they're like, okay, self-direction, maybe I can get into real estate and maybe I can start, investing in other things that I haven't been able to invest in. But walk me through how they could actually move those from a 401k 457 TSP plan into a self-directed environment, because I know there's some obstacles here.
Yeah, the obstacles in most part for moving funds. So if you have what the IRS calls a qualified plan, whether that be an IRA, some type of IRA, or as you mentioned, those 401ks, those 403b plans through an employer, the only real restriction that you have in moving that money to a self-directed IRA is if the money is tied up in an employer's plan for someone you were still working for. So if you're working for a company now as a W-2 employee, they can restrict your ability to move the money out while you are still employed. Some companies, though, have exceptions. When you turn age 59 and a half, you can definitely move that money from some of those funds, at least from the 401k, those 403b plans, into an IRA. And really the mechanism for doing so, the process, if you want to, when you're ready to self-direct, is first establishing the self-directed IRA, with Advanta, filling out the paperwork to establish a brand new IRA. And then we will walk you through whether we need to submit a transfer request to move money from one of your other IRA accounts, or whether or not there needs to be a direct rollover from that old employer's plan. And you would reach out to your former employer's plan for the paperwork. You would simply say, I need to move money out of this account to an IRA with another firm, and they're going to send you a packet of information or maybe a few documents that you have to complete, sign, and direct them to send the funds via direct rollover to Advanta. But that's something that we will assist you with, up front. We help you identify, okay, let's see where your funds are currently at. Is it a transfer? Is it a direct rollover? A lot of people use those terms interchangeably, but they do mean different things depending on your other custodian. So that's something we walk people through up front. But the good thing is both transfers or direct rollovers are tax-free movement of funds. So when you have that money in an old 401k or you have it in an IRA, and your advisor is saying, oh, if you don't want to pull that money out, you're going to have to pay taxes on it if you want to invest in this syndication deal. The reality is you're not taking the money out personally, which would trigger taxes and penalties. You are keeping it under the tax-sheltered umbrella of your IRA, moving it from just simply one custodian to the other, and then making an investment using the IRA account itself. And that's something that a lot of advisors, I've even had some CPAs that just don't quite grasp that concept and end up giving their clients some bad advice or some misguided advice, I should say, when doing that. So we facilitate that entire process. It's establishing an account with us, then just directing your other custodian to send whatever amount you wish from that old plan or from that IRA into the self-directed account.
I love this. And I want to put a pin in this because we're getting into kind of the tactics of like how to make that move. And I don't want to lose sight of the fact here that you don't have to move all the money. You can even just move what you need for whatever transaction you want to get into. But let's take a pin in this here. I want to back it up a little bit. Like what would be the benefits of somebody actually getting into a self-directed IRA? Let's start there.
Yeah, Whitney, typically I kind of look at maybe benefits or motivations, kind of the three things that I see from clients, and a lot of people, these three ideas really hit them, all of them, all at once. Maybe it's just one. For some people, the benefits of self-directed IRAs is maybe the tax benefit. If you're making an investment, so let's say take an individual now who may be in a higher individual tax bracket. You don't want gains from an investment coming to you now, because that's just going to be more and more tax that you owe in a given year. You can make investments using your IRA and have all of the gains flow back to the IRA, which is tax deferred, and able to then, for this year at least, and then for the life of that investment, not have any tax repercussions on an individual basis. Another big benefit, we talked about Wall Street investments. A lot of people are uncomfortable having their entire portfolio tied to markets, tied to companies where they have very, very little control, maybe very little knowledge about what it is that they're investing into. So a self-directed IRA gives you the ability to pull some of that money away from Wall Street and put it into investments, either that and can control, or maybe at least that you, at a minimum, you understand at a much more intrinsic level and can follow, hey, this is where the cash flow is going to come from. This is where my gains come from, as opposed to, picking a stock, picking a mutual fund and hoping you pick the right one. And for a lot of people, the last benefit is simply, a lot of our clients are real estate investors, or maybe they're already investing in syndications personally. And then the next deal comes along that, hey, I can't miss out on this one. Where is my cash to make the investment? And they simply maybe don't have it personally, or don't want to part with their personal funds for that investment. And they look and they have that balance in their old 401k or their IRA. Like you said, they can pull a portion of that out in order to make the investment. So I think the benefits really are having an additional source of capital for the deals that you already love and invest in. For some, it's the tax benefits, and for a lot of people, again, it's just the diversity of getting some of your money away from Wall Street, getting into something that you can control, and hopefully drive a much better return.
Awesome. So, I mean, obviously there's benefits here, and, you and I had a lengthy conversation about this last night, and, I'm a huge proponent of self-direction. I mean, however, there comes a mindset shift, when you get into self-direction, because now you're in control, and you're in control. You're making all of the decisions there on your investment. So let's touch on what are some of the maybe implications, limitations, or drawbacks to this type of maneuver.
Sure. So I think one thing that's important, and I think I like to point out all the time, just to make sure it's kind of covering us a little bit, but it's very important for someone to know, is that a self-directed IRA custodian is not an investment advisor. So they are not doing due diligence on any particular investments that you're making. So it's always important with a self-directed IRA that you understand what you're investing in, and that you've done your own due diligence. And like you said, you are in control now. So if you open up a self-directed IRA account and move money, and then waffle on investments or sit on your hands for quite a while, your money is not really doing anything for you. The self-directed custodian is not going to place your funds into any particular investment without your direction. So it is self-directed IRA are for people who want to be more active and involved in their decision making, both I guess good and bad. But for the most part, our clients, that is a huge benefit to them. It's not a drawback that they have to do more work or more due diligence or finding an investment. They want to do it. Or someone's already found the investment and they just want to be able to, like I said, participate, and their IRA provides them the cash flow to do so. Or the available cash to do so. So I think that's, again, it's you as an individual are responsible for your financial future. You can put the money in a brokerage firm and sit back and when you open your statement 30 years later, hope that it grew. Or you could, take some initiative and actually be responsible for, like I said, a portion of it in self-directing. That's where, again, I think there are definitely the implications are, if you're going to invest in these assets, you do have to be involved. So if you're somebody who just doesn't want to be involved, doesn't want the details, then sometimes self-direction really isn't for you, because it is a little bit, there's a little more to it than say just your regular brokerage or bank IRA account.
Mm-hmm. And this is why I love, pairing syndications, maybe even fund investment with self-direction, Because I think for that investor, at least for me, I'm speaking for myself because I'm not an investor. I mean, I have my active investments, but there are some added hoops if you're going to actively invest with your self-directed IRA. And I want to touch on those here in a second. But I think syndication, for somebody who doesn't really want to be fully active and like go find the house, go find that non-recourse lending, those type of maneuvers, but they want to have that power of exposure to other assets. That's where I think syndications, and it can be in multifamily, self-storage, residential assisted living. There's all different types of syndications out there, but you can kind of harvest the best of both worlds, right? Take an asset that you want to have exposure to, like real estate, but still have a very passive role, but put it in a type of an account that you have more control over. Now, I know most of the people here are, invested in or want to probably use their funds for syndication investment. And we're going to go through kind of the A to Z, end to end on how to make that happen. But I would love for those people that are just curious, say they want to buy a house with their IRA account, their self-directed IRA account. How would that happen?
So if you want to buy a house with your IRA, you would want to, again, get an account established. So you have kind of the baseline. You have an account to actually use to purchase the property and work on getting the funds transferred. For an actual real estate purchase, when you are drafting that contract, the contract you're going to hand to the seller as your offer, they're going to sign it to consummate the deal and begin the closing process. You actually make the contract in the name of your IRA account. So rather than writing, say, Joe Smith as the buyer's name, you'd write Advanta IRA, FBO, which is for benefit of Joe Smith's IRA. So you're designating and showing the IRS and anyone else who's looking that this is an investment you're making with your IRA accounts. That's why when the funds leave your IRA to pay for the property, there's no tax consequence. And then going forward, then any gains, the profits you make on that real estate all flow back into the IRA, tax deferred as well. So it's evident that that's the investment held inside your IRA. The initial stage would be the contract, and then a representative of Advanta, we work with the closing agents to make sure that all of the deed, the settlement statement, title insurance, any closing document has that same verbiage, Advanta IRA for benefit of your IRA account is on the title. So that's a very important part of the process that we do. And the same thing really, when you look at a syndication, you're not doing a contract or maybe a deed, but you are filling out subscription documents. And when we look for that same wording to be on the subscription documents for a syndication as well. So again, acquiring a property though is going to be, so you're going out and finding a piece of real estate, negotiating the purchase price, approving all the closing documents, and then going forward, once the property's been purchased, you need to arrange, you need to find your tenants, you need to arrange for your contractors, if there's work to be done on a property. All the expenses for that property need to be paid by the IRA account, and you would direct us to pay those bills. So again, we talked, like you said, there's a huge range within self-direction and in real estate investing of how involved you want to be. And so certainly full-time real estate investors, maybe more the type A personality, might really go for, hey, I want to own my own property, right? I'm going to be in control. I don't want to answer to anyone else. I don't want to have to depend on anyone else. And they look for that role. Then you also have certainly people who have the W-2 job who are more passive, but they don't want to just sit back and hope Wall Street delivers to them in their retirement account, right? They still want to take an active role with their investments, but they want to look for something more passive, like a syndication, like a private lending type deal. So I guess you asked a moment ago, kind of some of the implications are that's something to consider. If you're looking at being that active and buying a single family property, you do have to be responsible for all the details, but you also have to make sure that you're not the one doing the work. There's some rules that prohibit you as an individual from doing certain things with your IRA account. So those issues come up a lot more when you're buying your own individual property with your IRA than do so come up when you're investing in a syndication.
Mm-hmm. Again, that's why I love syndications and self-directed IRAs. I think they're like peanut butter and jam on a slice of bread. So they just go really well together. So let's talk, because we've only alluded to self-directed IRAs like kind of an umbrella. What are the different type of accounts that are available that somebody could take advantage of?
Sure, that's a great question. So when we talk about self-directed, that really is referring more to your ability to use your retirement money to invest in a variety of alternative assets. But self-directed IRAs at their core are still, traditional IRAs, the tax-deferred IRA. You have Roth IRA accounts that are tax-free, retirement vehicles. You have SEP IRAs and simple IRAs that are great for sole proprietors or small businesses that allow for a greater contribution level each year. And you also have solo 401ks. People who, again, who are self-employed can start their own individual 401k, and there's a huge benefit to those accounts we'll talk about, I'm sure, in a little bit. So really, any of those accounts can be self-directed. Regular IRAs, Roth IRAs, SEP IRAs, and I mentioned again those old 401ks, right? The 401ks, the 403bs. I think it happens probably quite often when you leave your employer. You're very focused on your new job. Your new, maybe you've had to actually have a physical move, and you're worried about moving your house and your family, and you kind of forget about that 401k. It kind of sits there for, and you keep meaning to get to it. And a lot of those accounts do languish and kind of sit there, but that money can certainly be self-directed. Again, it's just a matter, as I talked about earlier, of completing the paperwork to do so.
Mm-hmm. Awesome. And I mean, just speaking from personal experience, I mean, if you're going to make that move, I would jump on the phone with somebody with a Vanta before actually moving that money from the old employer to a new employer. Because and correct me if I'm wrong here, Scott, if somebody moves it from one employer into the new employer's account, now it's locked up there, correct?
Yes. Well, sometimes it's not. Okay. Sometimes the new employer does have provisions that allow you to still take that money out, but there are many who don't. And so I would almost universally, unless there was some really unique investment available to you in your new 401k, I would almost universally say take your old 401k and just put it into an IRA, because those same mutual funds and things you have in your current 401k for your new employer, you're probably going to have those similar investments available through some other type of brokerage firm, if that's really what you wanted to do. So, but putting the money in the IRA gives you a lot more flexibility to later move it, again, to a self-directed IRA, into other types of assets, or maybe just changing your complete portfolio altogether. But if you move it to that new 401k that you're invested with, they can restrict your ability again, to move that money out later. So definitely think about that before you, like you said, before you sign that paperwork to have it just rolled over.
Yeah, that is, I committed that mistake many years ago and locked up my money for 11 years. I mean, because my employer wouldn't let me have it back. And anyways.
Yeah, that's frustrating for sure.
Life experience there. So let's entertain, like, what, okay, I'm somebody that's new. I know I have like money sitting in a brokerage account. I want to start getting into syndication, fund investment, maybe other types of assets that I can't have access to at Vanguard or Schwab or Fidelity. I call you. How do I know what type of account that I should open?
So typically, if you're coming from a former employer's plan, you're going to either be rolling into a traditional IRA or rolling into a Roth if you do have some after-tax money inside that old employer's plan. So it's typically, when you're doing a self-directed IRA, what type of self-directed IRA you open is dictated by where the money's coming from. You can do a like-to-like account, and again, those old 401ks can really roll into traditional IRAs for the most part with no tax consequence. If you are self-employed, though, so let's say you left your W-2 job and you're actually now going to work for yourself, the SEP IRA or the solo 401k are two types of accounts where you really can, they're still tax deferred, so you can still move that old plan into one of those two accounts. And you can also just simply make much larger contributions. The IRS limits you with your IRA accounts only in how much you contribute on an annual basis. And for, say, a traditional or Roth, your out-of-pocket contributions are limited to $6,000 a year, roughly. If you are self-employed, though, or you have even if you just have a side business, you can open up a SEP IRA or a solo 401k that enables you to contribute close to $61,000 per year for 2022. So that's something, again, that we do at Advanta when you're looking to move over, is kind of evaluate, okay, what accounts do you have? What are you looking to do? And what's your kind of personal situation? And if a SEP or a solo 401k is available to you, certainly mentioning that as an option if you want to continue to contribute, as well as have those earnings pile back into your account also.
Awesome. So I want to kind of switch to a little bit of something that was in the news, because before the holidays, the Build Back Better plan was on the table. There was a lot of discussion, and I know at least for me, I had a ton of emails that were hitting my inbox for me to call my senators, congressmen, and ask them to remove the provisions that were in there that would limit me as an investor to invest in private equities. So can you just like give us a little bit of history of what was going on there and where we are now with that type of legislation?
Absolutely, absolutely. So the first kind of inkling we had of this came back, I think, in about mid-September, I think was when it first came out, when they first released a draft of what's still to be passed, if ever passed, is the Build Back Better plan that gets a lot of attention in Congress for a lot of other reasons. I mean, there are other provisions in that bill beyond, obviously, IRAs that are being bantered about in Washington. But in the initial draft of the bill, there were some provisions relating to IRAs that would cap the total amount you could have in retirement accounts. But for the self-directed community, it was limiting your ability to invest into things like syndications. There was a provision that would prohibit investments that relied upon your education status or your wealth status. Looking at your financial statements, things that most syndications, you have to be an accredited or sophisticated investor. That would no longer have been allowed with an IRA per the legislation. And additionally, there was another provision that would take away the ability to have what they call in our industry checkbook control, where you can kind of set up your IRA into its own LLC and really get even more self-managed of your assets. So those were two provisions that were in that first draft in September. And as you mentioned, Whitney, I'm sure that many other companies did it as well as Advanta. We alerted our clients, hey, this is the first time we'd seen something like this in actual legislation that was, at the time looked like it could certainly pass and was in danger of passing. So obviously we sent letters, you sent letters. I'm sure some of the people on the call may have sent letters to their congressman. And the latest draft, eventually I think with all that pushback that they got from their constituents and maybe even some of the senators and representatives themselves who have self-directed accounts said, wait a second, this is going to hurt me. Those two provisions were removed. So the latest draft of the bill, which again, the current bill is potentially dead in the water as it is. But as of now, those provisions were removed from the draft of the Build Back Better Act. There are provisions still in there that would cap the total amount you have in your IRA accounts, I think to around 10 million or so. There's some limitations on doing some conversions to Roth, which is a different topic we could talk about another time. But the provisions relating to self-directed IRAs were removed from the bill. And like I said, right now that Build Back Better Act, if you Google it and look and see what the latest is, they're still trying to negotiate whether they can even get the votes, the two votes that they need to even pass the bill, but it's not currently in that legislation. So we'll continue. I'm continuing to follow it though, because you're always afraid they try to slip something back in. And if it's on their radar now, it certainly may be on their radar in the future.
Now, I really do want to set this into context because it's not the government going after, the regular investor. There's a story behind this. There's always a story behind this. And will you share with us what that story is?
Absolutely. So there's some people you may be familiar with the name Peter Thiel. Peter Thiel, he was the founder of PayPal. So a lot of people use PayPal every day. Started out obviously as kind of his idea, and when he started the company, he used a Roth IRA, which is the tax-free vehicle. Used like $5,000 in a Roth IRA to purchase a bunch of initial stock in PayPal. And as PayPal grew and has exploded, and people started becoming used worldwide, he ended up selling off the stock and for a profit. The value of his Roth IRA is $5 billion within his Roth IRA account. Billion with a B, not million, 5 billion. So he was able to really take advantage, I guess, use those words, of a tax-free system that really was created for middle-class America, regular individuals to save, and abused it by doing and buying that closely held stock in PayPal. So it's really, I think that was and there were stories that when he ran for the presidency several years ago, Mitt Romney with his IRA or his Roth IRA being worth in the $60 million range. So it's really, I think it was an impetus to go after those types of activities, which were perceived to be coming from these private stock, these private equity things that must be available only to those, uber rich individuals that we had to crack down on to prevent that. But the reality is, as people listening to this call know, it's everyday Americans too that are taking advantage. And the crazy thing to me was 2012, the Jobs Act was passed that was supposed to allow for more people to have more access to these types. That was the impetus for passing that, was to, hey, we can't just let the Mitt Romneys and the Peter Thiels have these advantages with access. Let's have it for more individuals. And that created kind of the crowdfunding. It's where crowdfunding originated from. So this would have flown right in the face of that in trying to open up this access. So it's a good thing that these are out of the bill. Like I said, it was kind of when those, as an attorney, they say bad facts make bad law. And so Peter Thiel's facts were unfortunate. They were very much on the extreme, and they tried to take that and rein it in to hurt. It would end up hurting the average American.
I'm so glad they're out of the bill, but you guys, we're going to keep a heavy eye on this, and thank you for demystifying like what was happening there.
Sure, absolutely.
Yeah, and we can only aspire to have that 5 billion in our accounts ourselves.
Yeah, absolutely. No, if you can do it, absolutely. But yeah, it was I mean, that's really is the outlet. I mean, when they talk about Mitt Romney with 60 something million, it was like, oh my gosh, how did he get that high? That's ridiculous. And then here comes Peter Thiel with his 5 billion.
Especially when you can only sock away like $52,000, maybe max. Like a year, that's a lot. That's a lot of gains there.
Absolutely.
So I have a couple questions coming in, and guys, I encourage you, if you're on the call, if you're joining with us live, drop your question into the chat box, or you can do it in Q&A as well. I'll field some of the questions with Scott here. If not, I'm going to stay on after the call for a few minutes and try to answer what I can as well. But guys, this is the time. Start dropping your questions in there. I do have one that's come in, and it's like, what happens if you decide to exit the IRA at some point in the future? What happens? Do you just pay the tax penalties and just wrap up the IRA? Like, what happens there?
So I guess I'm looking at this question two ways. We'll take kind of maybe the more opposite. When you're ready to exit your IRA or take money out of your IRA for personal use, right? So the benefits are you put money into this account over a period of years, it grows tax deferred, it multiplies more quickly, being in a tax deferred environment. When you reach retirement age, you pull the funds out of the IRA. If you're in a regular IRA or regular 401k, that money is taxed to you as you pull it out. So if you're whatever your income tax bracket is at that time, that's what you're paying in tax. So if you exit the IRA, pull money out, what you pull out is simply taxed, unless it's a Roth IRA, as Peter Thiel well knows. Roth IRAs are tax-free. You pull that money out in retirement tax-free. You can take money out starting at age 59 and a half without any kind of penalty, but it is included in your income tax. Now, the other way I was taking that question is, let's say I wanted to exit, say, my syndication investment. I made an investment in a syndication, that syndication is paid off and the money is back in my IRA. At any point with an IRA account, you could transfer the cash from a self-directed IRA back to a brokerage IRA, or from a brokerage IRA to a self-directed IRA. There is no limitation on doing that. So if the question was in that vein of, say, how do I exit a self-directed IRA? You simply have your brokerage account. You set up an IRA at a brokerage firm and have them request a transfer from us, and the money goes right back into a different investment. So hopefully try to answer that question two ways, because I wasn't sure kind of which way they were coming from.
Okay, no, thank you. All right, most of the people on here are real estate investors, and we've heard it heavily in the news, various blogs and stuff like that. If you, and I'm just saying a hypothetical, playing devil's advocate, if you invest through a syndication in your self-directed IRA, you will end up paying UBIT. Can you help demystify on a very high level? Because this is complicated, guys. This is very complicated. But can you just maybe define what UBIT is, and then on a high level, what might be happening here?
Sure. So UBIT, or unrelated business income tax, is a very little known tax that mainly a lot of people associate it with churches and universities who have to pay tax on income they receive unrelated to their tax exempt status. If say a church had a bake sale, in a sense, maybe proceeds from the bake sale would be subject to UBIT. When we're talking about an IRA, IRAs are supposed to be passive investment vehicles. So if an IRA is in receipt of income that is considered not really passive, which more like a business income, profits from an ongoing business enterprise, as opposed to dividends or rent, the IRA can be subject to that tax. But in the realm of syndications, the other way that the IRS levies a tax against an IRA is if an IRA is invested into a debt leveraged asset, like most syndications are. How UBIT works in that type of an arrangement, a very simple explanation. Let's say that the underlying project is 70% leveraged. Your IRA would pay UBIT tax on 70% of the income that it receives each year. So you'd have to kind of factor that into your overall return. Now, the benefit, though, that you get if your IRA is subject to UBIT is that your IRA can also take, in my example, 70% of deductions, depreciation. The IRS even gives you $1,000 automatic deduction each year for UBITs. So a lot of times for syndications, for the first few years, IRAs don't even pay UBIT because of the deductions that they get and that other depreciation aspect of it. One important note, so that's maybe does that answer the question? We have how deep we want to get into UBIT, but it's something to be aware of if your IRA is investing into. It's not prohibited. It's not on the same realm of, say, buying something from yourself. It does not allow. This is simply a tax that, if applies, your IRA pays the tax. You personally do not pay it. It is your IRA filing its own tax return to pay that UBIT tax. If you have a solo 401k, and bringing that a little full circle, for individuals who are self-employed or have a side business, you could set up a solo 401k as opposed to an IRA, and solo 401k plans do not pay UBIT tax on debt leveraged real estate investments. So kind of a thing, if you're looking, saying, hey, I want to invest in syndications, concerned about UBIT, if you're a sole proprietor, if you have a side business, the solo 401k is going to help you sidestep that issue altogether.
Awesome. All right, no, there's so we can go so far down the rabbit hole there. It's pretty insane. But no, thank you so much for describing that. Now, when we were talking about the different types of accounts, I think there was something that I wanted to ask you. Can you invest in anything with the IRA?
No, not quite. But the good news is almost anything. Because with the IRS, when IRAs were created back in 1974, and they wrote the laws for what you could or couldn't do with your IRA account, there are only two prohibited investments that you cannot make within your IRA. The only two prohibited investments are either life insurance or collectibles. And collectibles include your antiques, artwork, vintage wines, collectible stamps, coins, things of that nature. Those are the only two prohibited investments. So other than that, whether it's investing in stocks, mutual funds, real estate, syndications, precious metals, cryptocurrency, really it's up to you as to what you want to invest in. You just have to find a custodian who will hold that particular investment, again, so long as it's not life insurance or collectibles. The other restriction I kind of alluded to earlier is if your IRA makes an investment into an allowable, say, piece of real estate, there are certain individuals, including yourself, your spouse, and some close family members, who are disqualified from transacting or benefiting from that investment. So in the context of real estate and keeping it simple, if you're buying, say, a single family home with your IRA, you can't live in it, you can't rent it from yourself, you can't rent it to your children, you can't do the maintenance on the property. There's some restrictions on those types of investments when it comes to self-directed IRA. So again, very little though. Some people get fixated on, oh, I can't do that. I wanted to buy this property and have my son or daughter rent it from me. They get fixated, oh, this is so restrictive. When in reality, if you just take your son or daughter out of the equation, there's so much more that you can do. Looking outside of those family members, because again, it's only life insurance and collectibles that are the prohibited investment classes.
Awesome. Well, I understand collectibles, especially the wine piece, because you could drink your investment. But
Correct.
But why not life insurance? I've always been curious on that.
To be honest, I'm not 100% sure. I know that a lot of life insurance is already tax deferred or tax free to some extent. Maybe that's part of it. Could be a public policy reason, because I have been approached over the years of people wanting to invest in something called viaticals, and how many people are familiar with viaticals, but essentially it's buying kind of life insurance on other people. So, or if somebody has a life insurance policy, giving them cash now for their life expectancy or for their life insurance policy, and if they pass away sooner than expected, it's a bigger benefit to you as an investor. So you can certainly make those investments outside of an IRA. So maybe there's some public policy there of just not wanting people to do that in their IRA and discouraging that type of an investment. That's really not sure. But yeah, the collectibles, definitely, you get personal use. If you have a Monet inside your IRA account, it's hanging in your living room, you're getting that, they're giving that benefit, whether it's tax-free in your IRA or if you own it personally.
Are NFTs considered collectibles?
The IRS hasn't ruled on that. I can tell you, as a company, we think that they are, because it's not something that has as ready a market, and it's because NFTs can be valuable because they're unique. which to me is in the same realm of saying that rare coin, that rare stamp that somebody wants to buy, as opposed to something that would be used in ordinary commerce, I guess that'd be my, yeah, we don't permit NFTs, at least on Advanta's platform.
Okay, awesome. Well, guys, I encourage you, this is the time, if you got questions, drop them in the chat box or in the Q&A box. But, while you guys are formulating your questions, Scott, if anybody could take away just one nugget of information, the most important thing here, what would you say that they should take away from our talk today?
I think that if you have money in an IRA or you have money in that old 401k, don't feel like you're trapped as to what you can invest in, especially when you see opportunities that come along, whether, that's a property in your neighborhood or say a syndication. Say, hey, this deal sounds really good. I look at the projected returns. I wish I could make that investment. That's something just to remember, that your IRA or your 401k can be used to make that investment. That's what, the people on this call are in the vast minority of people who even understand this is possible. A lot of America, even people who've had IRAs or 401ks for years, I talk to them every day when they give us a call and say, I didn't know this existed. I've had an IRA for 30 years. I wish I'd known about this sooner. Right? Because I've told you now, and you've listened to the webinar today, that you have that ability to do so. So if you see an investment opportunity, consider using your IRA account for it, and know that those monies can be used for it, and know that you're going to have a little bit more involvement as well as an individual in evaluating the investment, finding the investment, and simply, I think just knowing that it's possible is very powerful, because it opens up your eyes to things maybe that you didn't think you could buy. Because my savings account, I have $30,000 in savings, and that's for medical emergency. That's for a rainy day. If I need it, I can't tie that money up in a 3 to 5 year syndication deal. But you didn't think about your IRA as a vehicle. And that money, you're not touching it anyway for another 10, 15, 20 years, maybe even longer. And that's where you can actually utilize and take advantage of these investment opportunities and not miss out.
Awesome. Well, so normally I ask how people can find you, but, Advanta IRA, let's, pivot the question a little bit here. Is how does somebody get started, and what timeline should they expect, right? If we have a deal coming out next week, should they open the IRA now, later? Can you walk us through that timeline a little bit?
Yeah, absolutely. So getting started is, again, the first step, contacting myself or someone on my team to help you get the paperwork started. But you do want to allow for a minimum of a week, but more likely probably 2 weeks, for the time it takes from we get your paperwork. You fill out your application, which takes 10 or 15 minutes to get the account opened. Then for the next step from there is getting your funds moved over. And that process, again, can take anywhere from a few days to a few weeks, depending on your other custodian. So you want to allow for, like I said, at least a week, possibly 2, in rare cases, maybe as many as 3. It just really depends on the other custodian. But give yourself that time frame. Once we have the account set up, we will work with you to get the paperwork established. The syndication investment documents need to be completed in the name of the IRA. We can begin working on those. On that paperwork, but it's going to be anywhere between that week to typically 2 weeks. If it's in another IRA account, usually we can get money moved fairly quickly. There are a few custodians out there who are not all very helpful in getting money moved, but most of them are. Most of them are pretty easy to get it done. So give yourself a week, 10 days from that, and that's from really the closing date. So Whitney, if your fund is closing in less than a week's time, we can't facilitate it that quickly. But if they're opening the fund and taking investors, get your account set up, get the subscription documents in, and ultimately then get that investment made once your funds arrive from your other custodian.
Awesome. Well, Scott, thank you so much for joining us today. This has been amazing. Let's just wrap up. How can people get in touch with you?
Sure, absolutely. It's one of 2 ways. You can email me. My email is smaurer@advanta, ADVANTA, or easier, just give me a call, 800-425-0653, and my direct extension is 1123. And I say this every time I talk. If it's on self-direction, obviously give me a call. But if you have a question, say, I have an IRA and I wasn't sure what the distribution penalties were or the distribution rules, use me as a resource and just give me a call, and I'll get those questions answered to you as well. And our website, advantaira.com, is also a great resource if you want to learn more.
Awesome. Scott, thank you so much for joining me today. Guys, we will see you here next week. And if you have additional questions, hang on the line. We will get those wrapped up here in just a second. Thank you and have a fantastic day.
All right. Thanks, Whitney. It was a pleasure to be on.